ready to rock and roll. And we started out yesterday with a couple of ideas about getting into trades. We'll obviously expand a little bit on that this afternoon, this evening. And the idea is to try and fit the trading narratives into what's happening on the screens, but also to look at who's taking part in some of the trades, what is their mode of operation, which we discussed in yesterday's classroom in passing. And some of these ideas are obviously all about the concept of transition. No, it's not the stuff that's always in the headlines these days about swimmers and athletics and all sorts of things, the ruination of women's sport, but it's about transitioning the trading from passive to offensive. It may well be offensive already, but trading the transitions is what Charlie D was talking about in his webinar, the key to success. Now, not the key to when do you know you've become a great trader, because what he mentioned about being a great trader was buying on top of a winning trade, adding to a winning trade. That's what he said was the mark of a great trader. But the way you get to be a great trader is you start moving into this transition phase of the markets. And there's many ways for you to look at transitions in the market. We're going to be looking at one very, very particular, very close to our hearts today, because it was a massive trade for us this morning. And it was on oil, interestingly enough. But the other thing you've got to try and remember is it's not just about structures. Because one of our first oil trades was about knowledge, was about inside information. And it's not inside information as much as it's a secret phone call you get from some Russian oligarch about what he's about to do on oil, although that happens, of course. We've tried to chat about that many times in the past. But basically, the idea is that not all structures are as straightforward as today's massive trade on oil, which was the buy trade at the bottom edge, but we'll touch on that. Now, did we get oil right? Well, I want to just, again, I don't want to go through a lot of screenshots today because I want to get into the classroom proper as quickly as possible rather than do what we did yesterday, which was waste some time doing some screenshots just to prove what it is we do and how we do it. So take a look at yesterday's trades, or take a look at last night's screenshots. Take a look at what we were saying last night about oil today. Let's take a look and see. Again, these are all time-stamped for the London session. And I'll just zoom in on the tweet itself so that we can focus on what it is we actually said last night. Apologies for the misspelling, but it is what it is. And one of the key aspects of trading, of course, is what we would call inside knowledge. How do you get an inside knowledge? Well, that's what we teach in the main classroom. The ability to generate some ideas, not on the, not in hindsight, which a lot of people will tell you about, and a lot of people also think when they first come into this classroom, yeah, it's all very good. It's all very good, and it's all very easy in hindsight, which is obviously the case with anything. But take a look at the timing of these tweets. Take a look at when the tweet was sent out, when the trade was taken, and at what prices. So the tweet was sent out at 11:34 p.m. after last night's classroom, in fact. 11:34 p.m. on the 8th of August, yesterday. Time-stamped specially for you. This is 11:30, remember, at night on London. 11:30 London last night. Oil. Supply is still in play. What do you think of supply, guys? What's the first thing that you think of in terms of what supply means? That means the selling market. The market should be dropping. The market is supplied. Supply is still in play. So you might say, but why don't you just say there's a sell? Because we've got to try and understand what's going on. It's not a triggering service. We're not saying sell it. We're saying understand what we're talking about here. Supply is still in play in oil. However, oil is still bid with the dollar offers on a macro scale going back to the beginning of August. So we're very concerned about, for example, the price of the dollar. We are factoring that into our considerations. In other words, it's like a fundamental view of the markets, isn't it? But it's not just a fundamental view. Yes, we believe that the market is supplying. Yes, we believe the market will be dropping. But it's not just about getting that fundamental aspect of the markets. Take a look at what we said at the bottom of the tweet. The macro sell was going to come in at $91 a barrel or higher. okay? So bearing in mind that this is at 11:30 last night, we are now telling our subscribers on Smart Alpha that the oil is going to be a sell at $91 or greater, but we expect the oil price to be rising because at that stage oil prices were below $91. So we're telling everybody, look, take a chill pill here. Don't be too aggressive on this. Be passive. Wait till we see that $91 or greater coming onto the screens, and then execute a trade to take advantage of the supply. Now, this was sent out, obviously, in terms of how long it took for the trade to take place. It was 7 hours later. Possibly, you might say, well, it was 8 hours later. Between 7 and 8 hours later, we get the trade. Now, obviously, during that period, things can happen. There could be a news release talking about Nord Stream. There could be something happens in the Ukraine regarding oil and gas. There could be a ceasefire agreed. Unfortunately not, but there could be, which could send oil prices tumbling. There could be an Iranian deal signed, which would also send oil prices tumbling down to $80 a barrel. So we can understand that there's a lot of fundamentals that could happen that could change an awful lot about what's happening in this tweet. And we just have to acknowledge that this tweet is only as good as the data that was available at the time when it was sent out. But what we're saying is, barring anything else happening, barring any other miracles or any other massive interventions from somewhere else, that there is a very substantial amount of supply available in the market to take advantage of. So we should be selling oil if we get above $91 a barrel. Well, that's good news, because what happened into the London Open, at the Brent market open, if we look to the right-hand side, or the left-hand side rather, of this chart, and obviously when we started to talk about this idea of $91, everybody in the room, you might say, but how do we get access to the phone call from the Russians? Surely that inside knowledge is unique to just whoever's sending out the information. Well, it's not, because what we're doing is we're making these decisions based on what we teach in the classroom called R squared. So based on R squared, you can see what happened next. At 7:10 on the 9th of August, in other words, 7.5 hours later, the price of oil traded north of $71 coming into the Brent market open. It traded north. It actually traded to $91.05. $91.05, guys. 5 cents above our supply level, our macro supply level. And we were able to sell some $91 oil, and by 9 o'clock, you can see that oil was trading at $89.05. In other words, per contract in oil, that's a profit of $2,000 per contract. It took us approximately 2 hours. 2 hours, $2,000 per contract. That is spectacular. It's not good. It's spectacular. Now, obviously, it came into a measured move. We touched on that yesterday. We'll obviously be looking at oil today because I want to show you the difference in having some inside knowledge for the sell, but having no inside knowledge for the buy, giving you still a very, very good opportunity to take part in a transition trade that had the structure breaks that we were looking for yesterday. So we took a $2,000 profit out of oil in this morning's session. And then we had this dealer's inventory, and you can see that at 10:30 on the tweets, you'll see it in the middle of the bracket there, in the middle of the box that you're viewing. At 10:30, we gave you the dealer's inventory level, and the dealer's inventory is what we call an RGL. It's basically a buy above, sell below type area. So the dealer's inventory, we told you, right on that screen, it's printed on the screen. The chart is on the screen, it's posted in Smart Alpha. And you guys know this at 9:30 each day. You know this going into 10 o'clock each day. You know this at 11 o'clock each day. So obviously you know where the dealer's inventory is. It's a price of $89.40 to $89.20. It's buy side above this level, sell side below. We'll take a look at what happened next. The price went above the $89.40, tested back into the dealer's inventory level, went back above at $89.40, tested back into the dealer's inventory level a few times, and then rocketed from $89.40 to $92.20. $2,800 per contract on the buy side. What? So on a one lot, for the London session, till 12 o'clock that day, you'd have been able to make $4,800 per contract on those two swings. Now, realistically, you wouldn't top tick the exit of the buy, and you certainly wouldn't bottom tick the exit of the sell. So realistically, what we always suggest is if the maximum swing is $4,800, that's what you would achieve if you were trading something like 3 contracts. So obviously you would just divide that by 3, and you'd work out what roughly you'd be able to make per contract if you were managing an open position of 3 contracts. That's what your target would be to be a good, solid, professional trader. So in other words, a 3 lot would have made $4,800 this morning from the London Open to the London lunchtime session. It's not hindsight though, is it? Nothing on this chart is hindsight. Nothing on this chart is something seen afterwards saying that was a great sell on oil because this was what happened and we could have sold this and we could have done that and we obviously were thinking were looking blah blah blah. You know what I mean? This is tweeted in advance, 7 hours in advance. Is this the kind of technique you want to have in your trading? Is this the kind of knowledge you want to be able to put on your screens in real time instead of in hindsight, like obviously all the indicators? Think about all those indicators that you're maybe using just now, stochastics, MACDs. All they are basically is price backwards, right? So you go back 10 periods, you go back 20 periods, 50 periods. That's all it is. It's just priced 50 periods ago based on some sort of mathematical formula. So what value is it? 0. None. It has no value. It hasn't got any predictive value. It tells you what happened. It doesn't tell you anything about what's going to happen. Well, fast forward to joining this class, and all of a sudden you see that we are selling $91 oil. We are selling anything above $91 to get that supply line in our favor. We're selling 91 and we're telling you it's 7 hours before it went above $91. The sell comes in and we make $2,000 profit on the swing. Everything is in advance. There is no hindsight to this narrative. So all the people who always complain about everything's always in hindsight and, you know, it's all very good in hindsight, but, they just don't get it. This isn't hindsight. This is the reality of trading real markets with a real institutional trade desk. Because obviously this is what the Russians are using. This is what the Arabs are using. This is what everybody that trades this is using. It's just nobody else is willing to tell you how it works. Nobody else is willing to pull back the curtain and really show you how it works, probably because the vast majority of people have never been on the back desk of a bank, working with the strategists, working with the quants, working with the actual traders in real time. $5,000 nearly in profits per contract on those 2 swings. Tweeted in advance. No hindsight here, guys. So let's get into it. Let's get into the actual ideas proper, and we can see now, you know, some of the thoughts about how to start marking up the charts. And obviously it comes back to this idea of making sure that your chart narrative is accurate, making sure that when you draw in your screens, when you start to draw in your ideas, that something is visible on the right-hand edge of your screens. Now, it's obviously very important for us to make sure that the right-hand edge is populated. One of the biggest concerns that anybody has as a trader is the right-hand edge is very scary. There's nothing on it. It's an open space. But it doesn't have to be an open space, because what we do is we basically build out what we call, rather cheesily, the matrix. And the matrix is simply about being able to populate something in the future with information that we might be able to use. So when we go back to this idea about drawing in the interns exercise, it gives us a couple of key ideas about where to start with information that we can bring forward. One of our main basic ideas, and this is actually something that you see quite a lot in the retail space, is the idea of a commercial buyer or a commercial seller. Not because they know it's a commercial buyer, but because of how the commercial buyer behaved and how the commercial seller behaved in terms of price action. It's the concept of toxic order flow. Now this is obviously good in hindsight. It's also good on the right-hand edge, because what we end up doing is we end up becoming the toxic order flow when you know the inside information that we know. So in other words, how did we sell that oil on an uptick when everybody else was selling oil on the downtick after we had already got our short trade on? So what are we looking for? Well, we already realized that there is a very basic concept that we use when we're looking for strong areas to deal from, and that is based on the floor traders, this idea of the market makers recognizing what somebody is doing. And that is, when does a commercial trader become a real commercial trader on the screen? So they're buying and selling all the time after all, so there's got to be something that stands out. So one of the things we talked about in class this morning was this idea of a market that's just selling off, and we'll talk about structure in a moment, but the market's selling off, and the market rallies, and the market sells off, and all of a sudden, me as a commercial trader, I come in and I buy 500 contracts on the bid. Okay, so I'm buying 500 contracts. So that's obviously going to be a limit order. It's going to be on the limit order book. It may be visible, it might not be visible, it might be a nice order, it might be sliced up into time segments, but we are buying 500 contracts. Now obviously, somebody has to be selling that 500 contracts for us to be buying into this. So somebody's crossing the spread, somebody's aggressive, and I'm buying 500 contracts. Now, one of the big questions we've got is that if that's a big contract, let's say the average size is 200 contracts on that particular candle in terms of whatever time frame you're looking at. Everybody's going to notice that 500 contracts, right? Everybody's going to look at that and go, what the hell? That is a big deal. But is this bullish or is this bearish? Well, nobody knows. Nobody knows. The delta's very bearish, of course. There's a lot of sellers in here, so it's probably going to keep going lower. But what happens if this is a huge, big commercial buyer coming in and buying this product, and you're trying to sell into this guy? You're just going to get murdered, right? And obviously what's going to happen is the volume's going to spike. So the volume had been trickling along quite nicely. The volume suddenly spikes, and everybody sees it. Every single person sees that spike in volume. And this is what we would probably term a kind of climactic candle or an aggregation candle, where we get a lot of people recognizing that activity in that location just there. But is it a buy or is it a sell? Well, in our world, might be both, interestingly enough, because it all depends what R squared is doing. But obviously, because this market is still on the down phase, the probability is that it's still a sell, but it's building into a buy trade. In other words, the long position is being accumulated by the commercials. So that's good news, because we can start to look for that accumulation. We can start to try and figure out what the hell is that accumulation and where is it likely to stop. As the price rallies away from this area, then of course, if I'm not chasing the price up and the price comes back down again, and I decide I'm going to buy another 500 contracts, am I buying 500 contracts to get long, or am I buying 500 contracts to close out a short position? Because obviously the answer to that question is incredibly important. So that is the question at this stage, isn't it? Am I getting long or closing shorts? Because if I'm closing shorts, it's not bullish, is it? You might say, well, kind of it is bullish, because if you're closing shorts, the probability is that you're no longer bearish. So there's a fair chance that this is starting to become a bullish bottom edge. Well, not strictly true, because we take out trades in certain locations, regardless of whether we're bullish or bearish. We'll still take some of our profits off the table, because we've got to manage inventory properly. So if we're bullish or bearish and the market's dropping and I'm in a sell position, I'm still going to take profits. Even if I'm bearish, I'm still going to take sizable profits, because we still need to manage our inventory properly. I'm going to book some of that cash. Now, it means that if I'm still very bearish, I might try and resell back into it, depending upon how much volume selling is still coming in this trade. It's a different conversation. But obviously what happens is the price rallies. The price rallies again, and then the price comes down. Now, obviously what happens next is to try and change this up a little bit. I decide to buy 1,000 contracts. Is that bullish or bearish? Well, of course, if you're watching this in terms of a volume analysis, the idea is that there's going to suddenly be this very large surge in volume. And obviously we had another 500 lot trade just here, another volume surge there, another small volume here, and then all of a sudden we get this whacking great big 1,000 lot volume coming in here. Is that bullish or bearish? It's the same answer. We don't know, really. But obviously what's happening here is that we're starting to see certainly a slowdown in price. You can see that even the drawing that I've shown you here is showing a slowdown in price, which everybody can recognize as what we call compressions into the bottom edge. But the point is, am I a buyer? In other words, when we look at this marketplace and we try and understand who's doing what, who's selling these 500 contracts? Who's selling this 500? Who's selling this 1,000 contracts? Because obviously what we're trying to do is we're trying to start to understand who's in what position and what is likely to be their next action if this takes place. So who is selling in here? Have a think about it. Who is selling? Who's selling the 500? Who's selling the 1,000? Well, who it isn't is the commercials. How do we know it's not the commercials? Because generally as a rule, the commercials don't sell using market orders at lower prices, especially if the price had been selling off. That's not the commercials' mode of operation. They are hedgers after all, and therefore on the basis that perhaps our value is rising on this stock or this asset, then there's definitely not going to be any commercial sellers coming into this price area. Who else is it not? Well, it's not the market makers either, is it? Because the market maker, as a rule, doesn't cross the spreads. The market maker, as a rule, doesn't trade with market order sells. The market maker trades very much like the commercial. They will buy passively on the bid as the price trades down into their buying areas. So if it's not the commercial and it's not the market maker, it must be the HFT algorithms, it must be the prop desk sellers. Now, this is good news because simply by recognizing that this is who it is that's the seller in these areas, we can start to recognize something very, very simple. What is their mode of operation? What kind of traders are prop desks and HFTs? What is the majority of HFT type speculative algorithms? Well, very simply, they are momentum-based algorithms. They're trying to drive price, or they're trying to get the price to keep moving in trends. They keep the price moving as far as possible with as much liquidity as possible. They keep pressing the weak-handed buyers until they come across a commercial buyer. But not just a commercial buyer, because they'll come across commercial buyers all the time. So the algorithms are going to keep selling this because they're still getting lower lows. In other words, there hasn't been a transition at this stage. Now, if you obviously decide to come along to our classroom, we'll obviously teach you how to find these accumulation areas so that if you want to be a fader of bottom edges, at least you're starting to join the commercials at the right time of the moves rather than the wrong time. But obviously, if you're just wanting to take something from these classrooms, then the idea is, well, we simply don't try and be the commercial trying to call the bottom edge. So how do we play this? Well, if we understand that usually what is happening here is this is either a large accumulation and there's still enough selling, so why would I want to take the price up at this stage as a commercial? Or what could be happening is simply as the price drops down, I'm delighted to take profits in this location here, and I'm delighted to take profits in this location here. But I don't want the price going up because I've still got a lot of profit taking to take. So I don't want to drive the price up past the previous levels, do I? So if we think about this as a single candle here, I don't really want to take the price above this level in my profit taking. And then the price drives again down through this phase here. I don't really want to drive the price up past this last seller because I don't want to change the structure of the marketplace. I don't want to give away my downside. I don't want to give away my downside. Why would I? Because I'm a buyer at bottom edges. I don't want to start buying at top edges. But let's assume that we change now. Now this is an assumption, of course. Let's assume I was short 2,000 contracts coming into this area. If I was short 2,000 contracts, I've just achieved an exit. I have now got off my trade in its entirety. Now let's make a further assumption about this trade, and that further assumption is I am now bullish. So how do I start taking the buy trade on? Well, obviously, if I now make an assumption that I'm now bullish from this point onwards, I've now got rid of all my short inventory. My job now is to try and get into a long trade. So the one thing I'm not going to do is I'm not going to sprint into the buy trade and rattle the price higher, because I'm simply never going to get any business done. So I'm still going to sit as passively as I can, hoping there's still enough sellers coming in to drive the price down. So obviously, if they drive the price down, I've now got a great opportunity maybe to buy 500 contracts. Now let's assume I'm trying to get long 1,000 contracts or 1,500 contracts. So I buy 500 contracts here, passively on the limit order book. Now, I only bought 500 because I was bidding 1,000, okay? So I managed to get 500, and I was bidding 1,000 contracts, or I was bidding, say, 1,500 contracts if you're trying to get long 2,000 contracts like we had before. So they never got filled. They never get filled. So obviously, if they never get filled, I am light 1,500 contracts. I've got to get those 1,500 contracts somewhere, and the bottom edge is starting to exhaust. So how do I get filled 1,500 contracts? Well, we know that there's a lot of aggressive selling in here. There's also passive selling on the upticks, obviously, from market makers and various other things. So obviously, if I come up into this price area here, I'm probably going to get filled a big chunk of my 1,500 contracts. So I'm going to start buying into this. I've just accumulated 500. The price rallies up into this passive sell area. We've obviously got all the algorithms still selling as well. We've got the passive sellers from the market makers. And I come in and I decide to buy, for argument's sake, just to keep it right, 1,500 contracts right here. 1,500 contracts. I've just crossed the spread. I've actually just crossed the spread, and this is the biggest single sign that the market is now at a bottom, because I'm willing to pay higher prices to get into my position. The market is likely to transition now, because the market makers are going to say, shit, there's no way I'm going to sell at this price if this guy's now crossing. If Goldman Sachs at the bottom edge is now buying 1,500 contracts at the top edge, I'm out of here. They're going to pull away their sales. The algorithms are going to look at it and go, what the hell, I'm not going to sell anymore. So who's left to sell, guys? Nobody. Nobody's left to sell. So obviously when this price originally gets jammed and it probably sticks around this area, maybe it drops off a little bit, what happens next is, of course, we normally see an incredibly fast move away from this price area. This is what we call toxic order flow. This is when we use the word toxic. And when we use the word toxic here, of course, now, what we're now seeing is that this is what the market makers call toxic. If this is what the market makers call toxic, this is great news, because obviously that's going to be something we can see in the charts. Now, this means that this turns into, you can see in the charts, now this means that this turns into a commercial buy area. So this now becomes a commercial buy. This becomes a commercial buy area, right? Does that make sense? So obviously this becomes a commercial buy area. Come on, the teddy bears. So this comes into a commercial buy area, and we can obviously see that in this commercial buy area, I want to know about this price. So we mark it on the charts, and we use as much language that people in the retail space are familiar with. So we call this a bullish order block, because we've heard that the vast majority of people in the retail space have seen this type of thing before. They know what it is. They've never quite understood it, perhaps, but this is what a bullish order block looks like. So this is a bullish order block. And we mark this price on the screens. And this price becomes something that we are knowledgeable about. It's something we can understand as important to us. And it may have zero importance the next time it comes up here, because it's only going to be important. And this is why price action traders simply don't get it right because they're missing the most important piece. Just because the price is at a bullish order block or bearish order block doesn't mean it's going to respect it the next time, because the reason why it was there the first time was because there was supply for the commercials to sell into or buy into. That supply might have vanished. The demand might have been washed up. So therefore, there's nobody buying at the same price or selling at the same price this time. So if you don't know that and all you're doing is projecting a bullish order block on the screens or a bearish order block on the screens, you're going to come into this area, put your sell in place, boom, you're in your sell, and boom, 5 minutes later, you're out your sell for a 10-tick loss. And you go, what the hell happened? Because some of them work and some of them don't. Well, that's pretty obvious because some of them are not going to have any value left when they come back into that price. And some of them will have lots of value left, and therefore they will work. But because you're only seeing a piece of the jigsaw puzzle, like every other retail room in this space, you're only getting that tiny piece of the jigsaw puzzle, then you're left wondering what ones work and what ones don't, and you're left looking at it going, I don't know. And that's the problem. Because you see enough that work that you say, there's something in this, I just don't know what I'm missing. Well, now you know what you're missing. The reason why the order block was an order block in the first place. So now we go back to my original slide, my original conversation. And the original conversation, if you look back now and you look at what I actually said about that oil sell, now you can start to recognize perhaps the difference between what we have in this room and what you're exposed to in the retail space. Because key to this information is this very, very simple central point. The very, very central point to this whole tweet that we sent out at 11:30 last night. Supply is still in play. So in other words, if I come into a bearish order block, guys, and supply is still in play, do you think that commercial seller is still going to be in the same place? Yes, right? So we know the commercial seller is still going to be in the same place because we know the supply is still in play. Why did the commercial seller sell it? Because of supply. They don't sell it because it's an overbought bloody stochastic. They sell it because there's supply in the markets. They're commercially trading this to get short oil. Not necessarily the futures, but in the basis trade, in the actual physical commodity. They're selling oil because there's a supply-led bit of business. So when we know that there's supply, and we've told you that there's supply, and we come into a commercial order block, and that supply is still visible, now you can use that commercial order block to sell it. Guess what? The commercial order block was based at 91 plus. So therefore, that commercial order block meant something. What else about 91 plus is important for me as a commercial seller? Number one, big volume. Why big volume? Because if we go back above 91 evens, there's going to be a lot of stops, there's going to be a lot of liquidity, there's going to be some option hedgers having to buy above 91 to hedge out, for example, a call option. So obviously in line with that, we know that there's going to be a lot of buyers above 91, so we can take the price up into that area. Secondly, it's coming into the Brent market open. In other words, we're getting the first real volume of the day starting to show up, not necessarily on the WTI contract on oil, but certainly on the London-based Brent oil contract is going to have a lot of volume available for me to buy into this or sell into this position, right? So now the order block has a reason to exist. It's not just a price action order block, which is what you see in the retail space, which means not necessarily nothing, but you're missing the single most important ingredient that you can put into order blocks. The reason why it works. The reason why it worked in the first place. Every other retail room does not teach this. They just teach that it worked. You should draw it in your charts. Bollocks. Almost irrelevant, but not quite. Because the knowledge that it's there is still at least better than nothing. So how do we draw order blocks? We look for things called toxic order flow, and this is one of the things when we start to consider this idea of being able to draw up your charts properly. Now, this means that when we come to the sell trade, we don't get that beautiful break of structure that we taught yesterday. We don't get the beautiful ability to add in easy money trades. You can see just simply looking at the sell trade itself on this current screen, you'll see that the break of structure, well, where was the break of structure here? Probably the break of structure was realistically here. The price breaks the structure, pulls back, and then you're only going to start selling it in these areas here. Look how much money you've just missed out on by only trading that narrative. Now, did you catch a cracking sell? Yes, sure. Did you manage to get some great sells into these last two trades here? Sure. But you've missed out on more than half of the move because you didn't have the knowledge of the top edge sell at 91, and it wasn't a break of structure. So while your break of structures are very, very powerful, you can see that really you want to have the full knowledge. You want to have all the knowledge if you're going to be a successful professional trader. But again, it's good to start somewhere. It's very good to start somewhere, so long as that somewhere is somewhere useful, somewhere important, somewhere practical, somewhere preferably objective, that everybody can recognize, which is what the point of this classroom is all about. It's getting that starting point to getting the right trade on at the right price. Now, one of the things you'll be able to recognize is, well, how the hell did we have a macro sell order block at 91 plus? How was I able to recognize that there was a commercial sell at 91 plus, which if the supply is still visible on the oil markets, that I could lean against, because the commercials who sold at 91 before are just going to come in and sell at 91 again. It all comes back to the first part of this classroom. The idea that we can simply recognize toxic order flow and the reason why there was toxic order flow. So when we understand that toxic order flow is this very, very fast money break to the upside, the drawing of order blocks is pretty much standard across the retail space. Everybody knows how to draw an order block on their charts. I'm probably saying that to everybody that already knows how to draw order blocks. Everybody in this room probably knows what an order block looks like, and everybody therefore can get ahead and draw in these order block areas. So let's take a look at oil from yesterday. So this is obviously us coming into last night's close, and when we look at this oil chart coming into last night's close, there's a couple of things that I want to bring into my charts before I get started each day. Commercial selling and commercial buying. Now obviously I've already recognized that the market is supply-led. You've already been tweeted that the market's supply-led. So are you going to be interested in the buy blocks? Not really, because the market's supply-led. In other words, any commercial order blocks at the bottom edge are not going to be that important to us because the commercials ain't going to be in it. Unless, of course, it's just to take profits. So in other words, because I already am knowing that the market is a sell market, I'm able to look at the market from one side only. And that side is the sell side of the market. So obviously, as we're coming into today's market, I look across my screens and I look at the last big sell side commercial order block. In other words, I want to see a fast moving sell. I want to see the green candle preceding the fast moving sell. I want to see follow through from the fast sell. And I want to see structural breaks from the fast sell. In other words, the commercial that came in simply resulted in the market maker withdrawing liquidity on the bid and letting the price drive. In other words, there was a shift in value. Well, if that's the rules of engagement, you'll probably agree with me that looking at this chart here, that we obviously break structure here. The price follows through from that break of structure. And from that point onwards, pretty much the price stays inside that structure break. So when I look at that structure break, I look at where the break came from. The way that I've always drawn order blocks in the charts is very, very simple. And that is to find the green candle that's rising. Now, why do we suggest finding the green candle that's rising? Very simple, because commercials sell on upticks. They don't sell on downticks. They sell on upticks. So if we get a down candle, it must have came from an uptick. So therefore, when we look in the background, I suddenly find that I've got a good sized green candle here preceding the big red candle here. Do you see that there on the screens at 2 o'clock on the 4th of August? If you want to look at this on your own charts, guys, this is oil on a 15-minute chart on the U contract. 4th of August, there is the commercial sell. Now remember, commercial sell on upticks. So it's got to be a green candle. So what am I going to do with that information? What am I going to use that information for? Well, very simply, I'm now going to go into my charts and I'm going to draw that area right there. Now, just by drawing that area, do you see that on the following day you had a great sell? So you've already seen an additional sell coming in from that very bearish order block. Some people say, but where do I mark it from? Is it the body of the candle, the high of the candle, the low of the candle? It doesn't make any difference. It's not a single price, guys. It's an area. So just draw the area. If it's got a tiny little spinner candle on it, draw the whole candle. If it's got a big body on it, draw the body. If you want to draw the whole candle, draw the whole candle. Nobody cares. It's not an exact science. So obviously when we draw that, what are we going to call it? We're going to call it, very simply, a bearish order block. And that's it. So you've now got a bearish order block. It's the bearish order block that broke structure. It's the bearish order block that caused the market to drop. It's a bearish order block that was caused by previous supply coming in. So now I can compare the supply to the supply we had then, and I can decide whether the commercial who traded that sell, and there was a big sell coming in. How do we know that? Because the price dropped a lot of distance. So I'm going to trade that sell area when it retests this, on any retest. So I look into the background of the charts and I think to myself, okay, where am I going to get liquidity from if the price were to retest this order block? And I start looking at the top edge of this order block and I think to myself, right, the previous high was here at 90.77. So I can mark off that previous high here. So I know that there's maybe some liquidity to be had above that price. I also know that in the vicinity, of course, that the nearest wholesale price where we're going to get some hedge liquidity is going to be the 91 evens number, the big wholesale price, 91 evens. Now all of a sudden, on the right hand edge of my charts, I now have my sell location to deal. I've got my reason to deal, which is that there's a lot of supply coming in, and I've now got my area to deal in, and I've now got my price location to deal in. Does everybody agree that that's what I tweeted 7 hours before the trade took place? Hopefully, you can all agree with me on this, that this is not hindsight information, right? We told you in the tweet 7 hours earlier that we had a bearish order block at 91 plus, and that was the bearish order block that we were going to sell into because we still have supply visible. So obviously what happens is we come into today's market. You can see here we come into today's market, and what happens? The price had traded into that supply at 1900 hours. Massive volume came in. No shit, Sherlock. There was massive volume in a supply area with supply. My God, that's almost revolutionary, right? But obviously, it didn't get marked down at this stage. You can see we hadn't got the market breaking. We hadn't seen a structure break. You can see that this was a nice opportunity maybe to get some business done, and the closing bell of last night, which is obviously going to be great news because we're getting the volume, we're getting the value, we're getting the location, we're getting everything we could ever want. The hope is that the price is still here at the Brent market open so that we can get a piece of the action. It's not just the Americans, right? We want a piece of the action as well. So I want to try and get my sell on at 7 o'clock to 8 o'clock in the morning, London time. So obviously what happens is we then get the stops. You can see it wasn't just a good stop run, it was a bloody brilliant stop run. So we get the stops, we take out the highs, we take out the highs, and we take out the highs a little bit more. You may be saying the volume was rubbish. The volume was rubbish. Bearing in mind you're looking at the WTI oil contract. We're trading the Brent oil contract in London, right? So we're trading the Brent oil contract, so there's a massive amount of volume coming in here. So we're selling into this, selling into this, selling into this, and then we get the structure break. Now, obviously, one of the things we talked about to you guys in classroom yesterday was, where does the locals mark down the price to? We kind of told you this, didn't we? We told you that they don't use Fibonacci rubbish. They don't talk about the markets in terms of a 1.6 bollocks. They talk about the markets in terms of 2 times their money, and that's pretty much it. So obviously, if I look at the market in terms of 2 times my money, there's the break of structure there. There's the high of the structure, just here at 91.05s. Does everybody see where the price went to, guys? Is it the 1.61 measured move, or is it simply just 1 times the measure, guys? Is it simply just 1 times the measure? Oh yes, it's simply just 1 times the measure. So ditch your Fibonacci in the bin where it deserves to be, and simply use the stuff that the locals use. Now obviously you can see that that is the perfect exit. We've just made ourselves $2,000 per contract. Life can't get any better, except of course it can. Now obviously when we start looking into some of these trade ideas, we can also recognize that there was other reasons why we bought in here. You might say, but I thought you said it was a supply market. Yeah, but I also said that the market changes as the day progresses. What was a supply market maybe neutralizes. What was a supply market maybe changes because a fundamental news report came out to change the underlying tone of the marketplace. And that's actually what happened on oil. So we can obviously see that at 11 o'clock in the morning, we thought we would let everybody obviously see what the cause of the pop to the upside was. And you'll probably be able to recognize here, if you wonder why, then obviously it's a fundamental reason. At 11:15, the Russia suspends oil exports via its southern leg of the pipeline and transit payment issues via Reuters citing sources. So a Reuters news agency comes out citing sources saying that, that the Russia had suspended oil exports. Now that's obviously going to be bullish oil, right? So we already know that there was a fundamental reason for the oil price to go up. Now that's okay. We'd already exited our trade. We'd already got away from this trade. But now we come to trying to diagram up how you could have been involved in the buy trade simply not by knowing any of this inside information. Because one of the things you've already established is that the ability to get into this from a structural perspective was very limited. It still made money, but it could have been a lot better, a lot easier, couldn't it? We've already established that. So obviously when we come down into the bottom edges from today's sell trade, right? So when we come down into the bottom edges from today's sell, then of course, one of the things that we're going to start doing is we're going to start marking up the narrative. The reason why we mark up the narrative is because it causes you to talk about the market in terms of supply and demand, about what you've seen. It causes you to think about the market in terms of commercial buyers perhaps coming in. It makes you purposely draw in areas of interest, points of interest if you like. It makes you purposely draw in day highs and day lows, swing highs and swing lows. So there's a couple of things that show up here. Aggregations. We always suggest to people that you mark up your aggregation candles. How do you mark up an aggregation candle? You just draw a line against the volume close. So in other words, when I get a volume close, does everybody see where the volume closes are? Look, there's an aggregation candle right there at 727. So all I'm going to do is draw an aggregation there. That never transitions. In terms of a volume transition, we're really just looking for a candle that goes back above that single candle. That's as basic as we can make it, right, at this stage. A transition is basically a candle that goes back above the open of that candle. That means that volume that's trapped in that area is now potentially trapped. It could be a transition candle. Well, that candle doesn't transition. It continues sell side, but it's a recognition that there's volume there for whatever reason. There's volume there, and it continues sell side. We can all agree that the next aggregation candle is this one here. And we can see that the high of that candle pretty much stays in play the whole time, doesn't it? It never really takes out the high of that candle again. So it never transitions into a buy trade when you think about it. Obviously, what we're trying to do here is we're trying to get the transitions. We're trying to line up these transitions. Now, we're not buying and selling when it goes above or below transitions, guys. That's not what we're talking about here. So then we get another aggregation candle here, and we get another aggregation candle here. We're just recognizing the aggregations. Now, if you're trading transitions, this aggregation candle here, which is pretty meaty volume. It's about the third biggest volume we've got that day, right? So obviously we do go above that candle. So a transition took place here. Well, interestingly enough, when that volume transitioned, when it went above that candle, you can see the price actually did trade all the way back up towards that previous transition area. Good news, perhaps. That might be the start of a buy trade coming in. That might be something, but you can see it doesn't ever give you a structure break. So we can obviously see that the structure break at this point is this level here. Why? Because the previous low was here. And based on that narrative, you can see that when we broke structure, the two prices that we were paying attention to was this place here and this place here. So obviously when we break structure in these locations here, it's just basically the highest high between the 2 points. The highest high between the 2 points is that price there. Did we ever break structure for a buy? No. So in other words, this is completely 100% objective, isn't it? There is no subjectivity in this analysis. The price doesn't go above this level, and therefore there is no decision to make about the break of structure. This is still a sell trade. Now, why is this important? Because algorithms who are trading momentum will only keep trading momentum whilst the structure stays in place for them. In other words, if you're a selling algorithm, if you're an HFT algorithm, sell side, momentum selling, if the buyers are getting successful, you're not going to be a sell side algorithm. The whole point is you want to make sure the buyers have no profits, nothing to show for their efforts, and they'll basically puke their positions as soon as you put a bit of sell side pressure onto them. This is very important we recognize this break of structure narrative. As the structure drops, as we start to see the structure dropping, and again now we've got a low of structure at this price, and we now break structure, and it doesn't matter which candle you count as the break of structure here, we now know that the highest high for that structure was just in here. All good? Yeah, sure. The price continues to break, the price continues to break, and then we get a reasonable rally back inside the next break here, and then we break another structure here, quite a strong break. And again, we've marked off the aggregation here, and then we get a strong break here, and it instantly reverses. Now that's, and then we get a strong break here, and it instantly reverses. Now that's interesting from a profile point of view. Most profile guys will be looking at you going, there it is. There's your buy trade, because they're now looking at a rejection of something. They're looking at a very strong rejection, and that is not a wrong interpretation in most cases. That's usually a relatively accurate idea that's happened there. Now, when we broke structure here, and then we broke structure here, the new structure high on that break was obviously right here. So what have we just accomplished? Structure break. Now what we've accomplished is a break of structure right here. So if that's a break of structure, one of the things that we start now recognizing very simply is this is a bottom edge potentially. So we can go back into this bottom edge, and remember what we told you to try and do. We told you to draw a box around the bottom edge when you get a level 2 bottom edge, and there it is. There's your box on that level 2. And all you want to do now is project that box to the right-hand side of your charts. And if you're going to mark anything on that box, mark it as a bullish order block. You've now got a bullish order block on the right-hand side of your charts. You've broken structure. In other words, the bullish order block didn't just reject the bottom edge. The buyers came in across the spread, and they pressed through the previous sell levels. Now, take a look at the volume at the bottom of the charts, and you'll see this for yourself. If you were to take a look at the volume at the bottom of the charts, you'll see that the volume of buying, which had been previously relatively quite quiet, we can see into the bottom of the charts, the buying volume is actually relatively quite small, really, isn't it? Well, take a look at the volume of buying coming in now on these higher prices. So previously our aggregations were here, then they were here, then they were here, then they were here, and then they were here. So that very bottom tick price was an aggregation, wasn't it? The bottom tick price was an aggregation. So, based on the fact that the bottom tick was the aggregation, and then we saw big volume coming in here, what are we now recognizing? What are we now recognizing here? that big volume there. What are we now recognizing here? That big volume there. If we go back to the original conversation we had about the transition trade, about the commercial that's trying to get rid of their short positions and trying to perhaps accumulate a long position, if we now go back to that as a narrative, if you look back at the original conversation that we had with you guys earlier, and we were talking about that 2,000 position sell that we had on oil, and we talked about the fact that the oil was selling 2,000 contracts, and when it dropped, we bought 500 contracts. That was aggregation. And then when it dropped some more, we bought another 500 contracts. That was aggregation. And when it dropped again, we bought 1,000 contracts to close off our 2,000 short position on the oil. What happened next? Now we're net neutral. We have no positions. We are in a position to buy oil. So obviously we're now starting to come in at the bottom edge for that 1,000 contracts or 500 contracts or whatever we get, because that's all dependent not on my order but on the sellings that's coming in at the lower prices. If anybody's stupid enough to sell down into us, we'll take whatever business they've got at this stage, right? So we might get 5 contracts, we may get 500 contracts. Now into the bottom edge, I'm now buying my 500 contracts. I want 2,000 contracts. I don't want 500. I want 2,000 contracts. So obviously into the bottom edge, I want to try and get that 2,000 contracts into my book. So the only place I can buy it a lot of the times is at higher prices. Remember that bullish order block for that 1,500 contracts at higher prices I talked about earlier? This idea that we're going to have to cross the spreads to get the rest of our position filled on the uptick. Well, we now know, because of yesterday's classroom, that we've broken structure, so the only trade that we want to take is a buy trade, correct? The only trade we want to take now is a buy trade. Now, you might be saying, but why were the commercials buying at this price? Well, we've got the idea that there was a dealer's inventory level here anyway. But if you understand a little bit about R squared, if I was to point out a couple of simple ideas on the charts that were happening at the time of the buy at the bottom edge, you'll be baffled and surprised and pleasantly surprised that this was not just an easy buy trade. This was the easiest buy trade you've ever seen in your entire life. Take a look at the bottom edge of this chart, guys. The orange line is one of our R squared lines for oil. It's a positive correlation with a very, very high scoring. It's not 1.0, guys, but it's pretty high. And look at the direction that it was traveling in as oil traded into the 9 o'clock lows. The value was going straight north. In other words, R squared was telling me as a seller of the previous high on oil, remember we're short 2,000 contracts at 91 evens. As a seller of oil, this is now telling me, get rid of your short positions. So my best bet is not to try and cause the market to go up. I'm trying to get rid of short positions, guys. I need the market to keep going down. Because I don't only just want to get rid of my short positions, I want to start building into a long position, correct? So now the price goes down because of manipulation, because of the movement of liquidity, because we'll sell some, cause the market to drop, we'll buy it back quietly, possibly using ICE orders, that type of idea. We'll sell it a little bit more, we'll put some more offers in the limit order book, we'll put some big liquidity at lower prices, and then we'll pull that big liquidity away. A lot of people see big liquidity at lower prices and they go, it must be bullish. No, it's bearish because price goes to that big liquidity. If you've ever used any type of depth of market, you'll understand this idea. Price goes to liquidity. It doesn't always bounce off it. In fact, it rarely bounces off it. So now we're trying to put in some bids, and what happens as soon as we pull the bids, the algorithms pour in and they drive the price lower again. I have no intention really of buying the market. I have no intention of really buying the market. When you think about it, that's the whole idea of, it's not the idea of spoofs, but it's because obviously when I put a massive buy in, the idea of a spoof is to cause people to buy. No, I want to try and make people sell. So it's the exact opposite, isn't it? I put a massive buy in, 10 ticks lower, and everybody goes, oh, wait a second, that might be a real buy. So they come down towards my buy, I pull it away, and all the algorithms pour in on a sell. The price drops. There's nothing stopping the price dropping. Everybody who'd relied on that buy trade suddenly chucks in the towel and says, what the hell happened to the big buyer below me? They've just pissed off. The price sinks, and I get more execution at lower prices. Great news. So obviously, you can see that R squared was very bullish for this buy trade. So obviously, we're buying on this phase of the downtick, right? We're buying on this phase, and obviously, we've already identified the measured move reversal. So by this point here, we are now flat the marketplace. We've managed to clear our 2,000 short position. We're completely clear of trades. Now my job is to try and get into a long position. Now that's pretty tough, right? So our job is to try and hold the price as much as we can, down as low as we can, as long as we can, to try and accumulate a 2,000 lot position. So obviously this is what this whole balance area in here is all about, isn't it? $89.40. This whole balance area is trying to bring the price down, to hold it, to hold it, to hold it, to try and get long 2,000 contracts. So let's go back to doing yesterday's exercise on oil. Now that we understand how the process works, the idea of the buyers coming in at lower prices, the buyers coming in at lower prices, the buyers coming in at lower prices. There was somebody talking in the guru space about market makers. And the comment was that the market makers don't know which direction the market's going to break. It's not strictly true. It's not strictly true. The vast majority of market makers know exactly which direction the market's going to break because they're given signals, because they know who they're dealing with, right? So in other words, if I'm buying from Goldman Sachs and Goldman Sachs are crossing the spreads, guess what? The price is going to be going lower. So if I'm a market maker and it's trading with Goldman Sachs' commercial desk, I know that the market's probably going to be going lower. So as a market maker, do I know which direction the market's going to be going before it goes? Yes, I do. That's why I pull away my offers or my bids to let the price now go because I don't want to get busted. To let the price go because I don't want to get busted on being on the wrong side of this, what looks like a commercial buy or a commercial sell. Market makers nearly always know what side of the market to trade on. That's why they build inventory prior to a market marking up, because they know Goldman Sachs are long, so they want to try and get long themselves so that they can sell at higher prices from inventory and not from a new short position. So now we've got the basics. What we're going to now look at is, well, let's get the chart marked up from the basics based on yesterday's classroom. So now we've got an order block at the bottom edge, a bullish order block at the bottom edge, this level 2 liquidity. So how did we get a level 2 liquidity from the charts? How did we manage to draw level 2? Well, we covered this in yesterday's classroom, didn't we? We covered this in yesterday's classroom. How do we get level 2 information on our screens? How do we get that level 2 knowledge that that bottom edge is now a box? It's very, very simple. And we simply have to understand the basic starting point of market structure. The basic starting point of market structure is to simply draw level 1s. So when we take out a high, we draw level 1. When we take out a low, we draw a level 1. So all we do, obviously, when we're drawing these ideas is when we draw a level and we take out a level, it becomes a level 1. Now, you don't have to draw anything. You don't have to type it out here, but that's a level 1. And that's what that is, right? That's simply a level 1 break. In other words, a sell for the interns, simply a sell for the interns in a short position. When the price breaks back up and through this, and it takes out that price there, what is this point here? Well, now what we've seen is we've seen a change in market structure, and we've seen a bottom edge commercial buyer. So what this price becomes here is what we call a level 2 buyer. A level 2 buyer is simply a bullish order block at a bottom edge, and obviously that is basically a commercial buyer right here. A commercial buyer, whether it's a commercial buyer to get long or whether it's just a buyer buying to book some profits. It doesn't make any difference. And we call this a level 2. A level 2 is simply a level 1 that's been reversed. Okay, a level 1 that's been properly and fully reversed becomes a level 2. And anytime we see level 2s, the high probability is a level 2 is a commercial trader. Whether, as I said, they're just taking profits, or whether, as I said, they're simply getting into a new long position, we don't know at this stage, because you're never going to know until you start adding some other elements to this, the fundamentals and the technicals and the R-squared statistical arbitrage type trade narratives. So this is good news. We've now got a way of being able to recognize a commercial buyer on the charts. So one of the keys to this now is, have you got the ability to tell me that that bottom edge is now a commercial buyer? The bottom edge that formed at 9:30 in the morning, which is now driven through the structural sell trade that we had at $89.50, is now completely taking that level out, and now we have a bullish order block, a level 2 buyer, which is also a commercial buyer. Well, the good news is about commercial buyers is they generally buy for a reason. They don't buy for 5 ticks. They're buying because oil's now too low in price. Well, we could see from the R-squared that I showed you at the beginning of today's classroom, we could see from the R-squared that we showed you, the orange line, that of course the oil's too low. It's massively underpriced. Massively underpriced. So we know that this is a very high probability that there is a commercial long here. Well, no shit, Sherlock. That commercial long was us. That commercial long was our bank. We were buying oil there because we'd been closing off our short positions the whole way down. So we had managed to start building our first net long position in that area, not by much, but we'd started to build a net long position, which is why we crossed the spread to keep building a position, because we're trying to get some big oil trades done. Our bank is about the second largest, on most occasions, on most trading days, is about the second largest volume trader of oil on the futures exchanges. So we do a lot of business on oil as speculators as such. We do a lot of business. Now, obviously, if this is a structural change, this is now the low print, and as the structure develops to the upside and comes back down again from a pullback, that is now the structure, correct? That's now the structure. So whilst the price stays above the bottom of this chart here, from the bottom price of $89 and say 5 cents, so long as the price stays above that, everything in this area is now a buy opportunity. Well, do you remember the idea of what a level 2 buyer looks like? A takeout of a low price and then the retest of that low price and then a break back inside that low price? Well, these are great areas because these are areas where the commercials get some liquidity. So in other words, every time we see in this, what I'm really interested in is not just the orders for the buyers, for the algorithms to come in as buyers, because obviously there's an algorithmic buyer up here at the very top edge at 89.80s. We can establish that that's definitely going to happen. We can see that there is probably an algorithmic buyer above 89.50 here because that's another level 1 break trade, correct? But one of the things that you'll start to recognize as a commercial trader is that every time we break a level to the downside, there's some short-term sell algorithms still come in. Believe it or not, there's still some short-term sell algorithms come into the markets. And when the short-term sell algorithm comes in, we use that as a commercial to buy from on a candle like this. You can see what happens to that aggregation candle. There's a big aggregation candle at 9.49. You'll see it on a 1-minute oil chart. So with a big aggregation candle at 9.49, what is that aggregation? That's our commercial buying on a downtick again. So when the price goes back above the red line, which it only just goes back above the red line, this almost becomes what we would look at as a possible level 2 commercial buyer. It doesn't break structure. It doesn't go back to the upside. So we know that the next time we buy this, it's going to be at a lower price still, unless the market breaks structure. So what happens next? Well, you can see what happens next. All I do is draw another line, the way we did in the original exercise. I draw another line, and guess what I'm looking for? A sell-side algorithm. I'm looking for sellers to come into the market so that I can buy from them inside this commercial long accumulation. And sure enough, as if by magic, we get another break to the downside, which instantly reverses. In other words, our buying comes in and jams the seller and pushes it back up again instantly. And again, you can see massive volume comes in at that point. Massive volume comes in at that point. That's kind of crazy, isn't it? So obviously that volume is very obvious. It's that buying that we're putting in against the sell algorithms that are still seeing this very short-term sell-side phase. So we can see that this market in the very, very, very short term, if we come off the 1 minute charts and we go down into the 10-second charts or the 15-second charts or the 5-second charts, to a lot of sell-side algorithms, anybody that knows anything about HFTs, they trade in the microsecond world, they trade in the 1 second world, the 5-second world, the 10-second world. They're trading these incredibly low time frames. So what they're seeing is a sell trend. Sell trend. What we are seeing is a commercial buy. We're not trying to compete with these short-term algorithms. They're making some money, by the way. They're actually selling. They're making some money. I'm buying from them. They stop selling. The price goes back up, and then they sell again to see if I'm willing to buy across the spread. And because the price is still selling down, I'm happy to just let the price keep coming down towards my buy opportunities at bottom edges. So this is a commercial buy here. So this was our big commercial buy here. We've got the buyers coming in at higher prices. We've already established that by these two very large volume candles here and very large volume candles here. And now we're buying on downticks here. So now you're starting to see what a commercial buy looks like. You see it? This is what a commercial buy looks like. A passive bottom edge, an aggressive top edge to test how much supply is in at that price, to see if the supply is very heavy or not that heavy. We don't want to try and mark up price if there's still a lot of supply up there, so we're testing that supply. We want to know if there's 1,000 contracts there or 500 contracts or just 100 contracts. We want to know if there's a market maker willing to try and press the price back into value. Now obviously during this whole process, we'd already established from an earlier conversation, all the way through this process from an earlier conversation, that R squared value line was going straight north. In other words, we are still massively buying oil the second we've got that opportunity. So obviously we're back into the lows, we buy some more, and then obviously if we have to mark up price, if we can mark up price, now we're going to start marking up price. Why? Because we've got our 2,000 contracts long, right? We've managed to hold the price in here for a long enough period to accumulate 2,000 contracts. Our biggest risk now is that a seller comes in and whacks the price down and we're now long 2,000 and we're losing a fortune. So now we've got to take the initiative. Taking the initiative means showing some sort of desire, showing some sort of commitment to the buy trade. We're now going to drive the price. It's called the markup phase. So what's going to happen next is we're going to try and drive the price through this first level. And there it is. See it? Do you see it happening? Do you see this happening here, guys? The big toxic drive higher. When we start putting down our intent to show the market makers, look, guys, if I was you, I'd stop selling. To show the market makers to stop selling. To show the algorithms, look, guys, there's no point in you selling either. Because we are now willing to take whatever you've got at lower prices, and we're willing to take whatever you got at higher prices. Now, the algorithms ain't going to like that, because the mode of operation for an HFT is momentum. It's generally, as a rule, very short term. It's generally, as a rule, a market that they have very tight stops on. So they'll take out their money very quickly, very, very small stops, and they'll get off the trade, and they'll switch off the algorithm. If they switch off the algorithm, who's left to sell this, guys? The market maker, and that's pretty much it. Retail traders, perhaps some really bad commercial banks. And believe it or not, some banks are very, very poor commercial traders. Some banks are rotten traders. They're every bit as bad as an awful lot of the retail space in terms of their percentage wins, and they rotate staff like nothing because they're trying to find good staff. They just can't find good staff. So there are banks that are just as bad as anybody else. People think all banks make money. That's not true. So obviously we get a big ramp up in price. You can see that very toxic candle. And it's not just a toxic candle, it's unbelievably toxic, right? So the market makers now get a message. Stop selling, beat it. So that we can make sure our bottom edge accumulation is now defended, and we have to sometimes spend a little bit more money. 200 contracts, another 500 contracts, just to make sure that the sellers get the message. Obviously what happens is we now have to try and take out this level, which is the next big challenge. We come into this level here, you can see that we now have a bullish order block here because that's a toxic buy candle. We've already explained why that's a toxic buy candle, because guess what? That was the candle you guys got involved in from the interns exercise, right? Am I correct? From yesterday's classroom, that's the one trade you would have had at this stage, this one right here, from yesterday's classroom, because we've broken structure, the market's now bullish, the price is falling down, we're constantly drawing down into that area, waiting for the price to break the first market structure on the way back up, correct? Correct? Absolutely spot on. So in other words, that's the first trade you guys would have taken as an intern. The far right-hand arrow is your first trade. And that first trade turns out to be a toxic order flow candle. Isn't that superb? Well, that's what happens. Because that's the same first trade as a lot of buy-side algorithms might take. So this creates what we call a toxic candle with follow-through to the upside. And therefore, this also creates a bullish order block. So we now mark up the charts as a bullish order block right there. So we've now got a bullish order block at this price here. So obviously as a commercial, this is an area that I'm going to be looking to try and buy a level 2 into. This is going to be a great place to start putting in some passive buy limit orders, if you like. So let's see what happens in a little bit more detail in here. Does anybody see what happens? Well, you can see quite clearly that we get jammed at the top edge at $89.80. We can see that after getting jammed, we don't quite manage to get the break above. We don't quite manage to get the buyers above the top line here. And the price pulls back and it starts getting into a bit of a dogfight. We've got a very, very nice flat bottom edge just here, which may bring in some toxic HFT sell candles. Now we know it's a commercial buy, so that's okay. But obviously if the price goes below here and then goes back above here, guess what we've got? You should all know by now. We have a level 2 buy trade. So when the price breaks below here, you might have a passive buy at 89.50s. But obviously, worst case scenario is you put a buy stop order at 89.60s, and you're taking advantage of what we call the Heisman trade, which is basically a level 2 buy. So when the price bounces off that price print here, it goes back above 89.60. The commercials have just bought into this area here as a level 2 buyer. Now, the commercials don't buy the Heisman. They buy on limit orders through this phase. They buy on limit orders. They're accumulating on the downtick, not on the uptick. Once they've got the downtick, they'll start pressing the uptick. And we've obviously got a couple of key technical levels here. There's a structure there. And obviously that high is now slightly higher than it was before. So we've got that little structure there. So these are two locations for the interns to take buy trades from, correct? Two locations for interns to now get involved in a buy trade. What happens? The price turns to now get involved in a buy trade. What happens? The price trades back into the order block and we get another chance to buy some more if we wanted to. And obviously we take a nice buy away from that area. And look at what happens to the trade, guys. The interns come in, and what happens to the volume? Massive surge in volume when the interns come in. Massive surge in volume as the algorithms come in. As the buy-side algorithms start to come into the markets, we get a big surge in volume. And what happens when we take out the next high? Another big surge in volume. There's the two intern trades right there, guys. So we've got the accumulation trades in here. We've got the accumulation trades in here. We've got the two intern trades there. We've got the one intern trade here. So we've now had 3 intern trades, all of which have made substantial money already. All of which have not required you to be a buyer of bottom edges. All of which have seen the perfect bottom edge forming, the change of structure forming, and the break to the upside forming. You didn't even have to know what R squared was doing to see the footprint of our trading showing up on the charts. A footprint of our trading showing up on the charts in real time on the right-hand edge. No lagging indicators, no stochastics, no CCIs, no RSIs, no MACDs. Real time, market-fed information, in other words, the auction process. Now, obviously, if this was the bottom edge and this was what we call the capper price, this is something of interest to us because every price has a narrative that we can unfold, because obviously this was the big top line here. So we obviously mark this area as a cap seller. We can obviously mark that line as a cap seller, and that's something of importance. If we break that area, we can obviously turn it from a cap seller into a passive buyer. That's just that idea that everybody knows in the retail space. Most people don't know why, but that's when we start talking about supply becomes demand. It's not supply becomes demand. It's simply the way that the market works in terms of what happens next. So in other words, a cap seller is no longer there. So anybody that did sell there obviously is now looking at getting away from their short positions at the best possible price. The lower, the better, of course. So what happens next? Let's see what happens next, guys. Look at that, guys. Look at that. We get a brilliant trade away, and obviously when we've got a cap seller here, all you're going to do now is just mark this area. Take it down into the balance area, and just mark this on your screens as a imbalance, buyers pending, right there. Imbalance, buyers pending. Now, obviously, something else that you're going to do is, once you've managed to recognize a cap seller and you've marked it as a cap seller, cap just means that the price is being capped at that price on purpose to try and force the price down for us to get liquidity on the buy side. Once you know that, you can start making some target prices. There's the high of the cap area. There's the low of the cap area. And now what we're going to do is make some targets. We now know that our first target, assuming nothing changes, is now $90.50. First target, guys. We've been buying since $89. So this means that we're getting a $1,500 upside if nothing changes. Now, obviously, as the price rises, things change. The value always improves. So this is only the starting point for our trade. It's not the end point. It's the starting point. So what happens next? Well, if we were doing the interns exercise, you can see that we had a level here. We had some small minor inside levels in here. So obviously, if you wanted to try and get in relatively sharp, relatively early, you had an opportunity to buy in here. You had an opportunity to buy in here. They all were both successful. They never get stopped out back into the prior lows. And obviously, the price just kept going. As we come into this interns level here, you can see a very big level. And obviously, that's a massive opportunity to buy into that level there for an interns buy. My God, look at the trade. Sensational, isn't it? It's absolutely sensational. Look at the size of the candle. Look at the toxicity of the candle. Look at how fast the candle's moving. Obviously, it takes out the $90. That's one of the big reasons. The sellers that were coming in at 90, trying to hold the market offered at 90, they were just getting bowled over. So they eventually capitulated at $90.30, and we had this enormous rally at 11 o'clock this morning. Look at how many interns buy trades we've now had, guys. Not the pullbacks, the actual interns buys. Now, we did have one pullback during this period. Remember, we're drawing in the level at the bottom edge as well. So for a commercial trade, we're trading any level 2. Now, it doesn't look like much, and it really wasn't much, but it was about 3 ticks wide. And that was a level 2 buy trade for a commercial right there. Level 2 buy trade for a commercial, guys. As I said, it's only 3 ticks wide, so it is what it is. Worst case scenario, it's what we call, as I said, the Heisman trade. So now we're moving again. Now we're moving. Look at this drive, guys. Look at this drive on oil. So based on another trade here, there's another opportunity to take another interns trade just there. A very big pin gives us a bit of a gap and a bit of space, and then we get another drive and another pin at the top edge gives us another interns trade just there. Now at this stage, of course, you might be forgiven for looking at this and going, oh my God, look at how enormous this trade's been. Absolutely humongous. And you say, yep, absolutely. And you might be saying to yourself, how the hell do you know where structure is? Well, at this stage, you don't really know, do you? Because the structure is a constant breaking of higher highs. So we don't really have any solid enough pullbacks to get a solid idea about where the break of structure might come in. The difference is that when we get this pullback here, now we've got a possible break of structure narrative because we've got a deep enough pullback that the buyers have a range to play inside. Now, obviously, when we get this pullback, guess what happens? We get a commercial buy trade there. You can see at the bottom edge. There's a level 2 buy box right there. And what do? We got a failed auction. So what are we going to do? We're going to draw another buy box here. What happened? We got another commercial buy trade there. Do you see how these level 2s start showing up all the time? Do you see how these commercial buy trades at lower prices start becoming the norm? Once, twice, sometimes 3 times. And then when we've accumulated enough, what are we going to do? We're going to mark up the price. So in other words, the algorithms are going to take over buying at 91.64. The algorithms are going to take over buying at $91.72. And we're going to send this back to the moon again. Hopefully. And what happens? The algorithms bought at 91.64. The algorithms bought at 91.72. And the algorithms bought at 91.86. So we got this massive upside ride from the algorithms. There's your interns buy there. There's your next interns buy here. And there's your next interns buy here. Now, when you think about this, really when you think about this, stop a second and just look at what the hell is happening here. Look at the number of buy trades you just had. Look at where they were. Look at where the buy trades we had. The idea, of course, of the dealer's inventory, which we posted as a tweet at the very, very bottom edge of today's markets. That inside knowledge of where things actually are, not where some sort of price action tells us it is. The inside knowledge of this morning's oil sell trades off the top edges, selling the $91 break right here, and being able to take part in that enormous short play with the interns coming in only in the last legs of the bottom edge happening here. The interns coming in during these phases here to take advantage of these moves here. Look at where those trades are, guys. There's no lag to this. There is no stochastic overbought situation. There's no RSI giving you false reads every time the market trends. There's no MACD divergence appearing on the charts. There isn't even a value line. There isn't an R-squared narrative. Of course, we've looked at the R-squared to show you why we were buying bottom edge oil and why we were selling top edge oil. There's always a reason for us as commercial traders to take those trades, of course. But look at simply what the interns would have done. Without all of that information, without being able to buy the bottom edge because you didn't have the knowledge, you were still able to make an absolute massive gain to the upside. If we simply take the swing buy trade when the intern first came in, which was right here, $89.50, and we look at where the price got to when the interns were still buying into this at $92.10, we're looking at a $2,600 of upside move. $2,600 per contract of upside move. So it's not exactly the kind of thing you're looking at and saying, it's tuppence halfpenny, right? It's not going to be that significant, really. It's not that important. $2,600 of profit on a buy trade without using any indicators whatsoever, and you think there's not a lot of value in this stuff. Get a fecking grip. Now, we're not telling you about price action trading. What we're actually trying to do is we're trying to get you to understand who trades in what location. If we understand who trades in what location, then we're obviously far better positioned to take advantage of the storyline that's forming. If I know that the storyline tells me that if the buyers are in here or if the sellers are in there or whatever is happening in these locations, if I know that stuff, if I really see that stuff happening, I can take full advantage without any other information on the charts. What we're giving you is an edge. We're giving you a volume edge. We're giving you a price action edge, but we're not just showing you if it breaks a line that's a buy, if it breaks another bloody line it's a sell. That's not enough, guys. What we're showing you is the reason why it's an edge. We're telling you about the HFTs. We're telling you about the way commercial operators deal in these areas. The accumulation process at bottom edges, turning into algorithmic buying at top edges. The reason why we have to mark up the price, the reason why you see volume at the top edge prior to the break higher. It's very important. In terms of its theory, this is very, very much in line with the concept of some of the profile guys. The reason that we're talking about this is we talked about the aggregation, marking the lows and the highs of an aggregation phase. As a price drops and we get, for example, a very large volume down candle, and it has, as I said, a lot of volume coming in, and we call an aggregation here, and we get another big down candle, and we get another big spike in volume, we call an aggregation here. And then we get another big candle, we get another big volume, we call another aggregation here. And then the price rallies, and there's not a lot of volume, so the price drops out. And then the price drops, and we get another big volume candle phase. Then, of course, what shape is this forming in terms of a market profile? It's a B shape. So one of the things that the profile guys will tell you, simply from their analysis, is a B shape is bearish. Why is a B shape bearish? Because if we look at what the profile's doing now, that's what the profile looks like, correct? So if that's what the profile looks like, if that's what the profile now looks like, then of course the idea is that there's enough selling at the bottom edge that it's simply going to keep coming in because there's enough selling at the bottom edge. But if that selling is getting accumulated by a big commercial, what's the chances it's just going to exhaust? Pretty slim. It might, but it's possible it might not. So in other words, the profile guys haven't got this right either, potentially. So what happens next? Well then, of course, if we are starting to buy into this now, and we start putting in some volume at the top edge, so the volume starts low and the volume starts building into the top edge to the extent that we get some big volume candles at the top edge, the sellers have had enough, and then we start buying and we get some big volume into the top edge again, we start seeing some big volume candles coming into the top edge. What's happened to the profile? Well, we can see if the big volume's coming in at the top edge, the profile was fundamentally changed from a B-shape profile to a very simple P-shape profile. So we've changed from a B into P-shape, and obviously in line with that P-shape, the idea is that that market is now bullish. That market's now bullish. We've now got the idea of a transition taking place. The market has transitioned in real time, not lagging. Not something you look back at in the profile and say, well, that's the transition there. Unfortunately, it was 200 ticks ago when the price broke higher. I can now see it, but I couldn't see it at the time. Every single time you get a candle, guys, you're making this analysis. Remember the bottom edge on oil? We started to see the buyers coming in at higher prices. We were able to say, what does that mean? We didn't have to wait for a profile. In fact, we never looked at a profile, did we? Not once did we look at a profile. We simply recognized the buyers starting to come in at higher prices. So when we look at the buyers coming in at higher prices, we already showed you this. What we suggested that you do was we suggested that you start marking off the price where the big volume comes in, here. Well, if the big volume's coming in here, the profile must start developing into a P shape. If the big volume comes in here, the profile must develop into a P shape, which means there's no buyers above me. So as a commercial, I would be delighted to buy at lower prices because I know there's buyers above me. My biggest challenge as a commercial trader is to buy at lower prices and not have any idea that there's any buyers above me because I'm not going to make any money. There might be massive amounts of sellers above me. Well, if there's massive amounts of sellers above me, I've not tested that supply yet, have I? If I buy now, I may well be way too early to the party. I might be way too early to the party, and because of that reason, I could put myself into a massively jeopardous position in my trading, couldn't I? So the verification that we've seen this not only have we seen a structural change when we broke the structural leg here, but we saw the volume change here. Very, very big buying above these price areas, and we marked those price areas. So we now know for a fact that there's a lot of buyers here. We know for a fact that there's a lot of buyers here. Well, if I can now buy into these low prices, is that not a great opportunity? If I can now bid this low price here, guys, is that not a great opportunity to buy back into that big volume buyer at the top edge? The common sense in this is off the charts, isn't it? The common sense on this narrative is off the charts. What you start to learn is, of course, about the concept of liquidity. The concept of grabbing liquidity in certain locations because of R squared. The concept of finding where the commercial liquidity grabbing is taking place. The idea of R squared being very, very interesting. The idea of R squared being very, very keen to show us what we should be doing as a commercial. But it doesn't mean that that's always going to be the case. We don't always get a bottom edge. We don't always get a top edge. We do sometimes aggressively start marking down our structures. But that's why the whole idea of trading is most important. This is a great first step. I hope you agree. That's why we're spending time with you over these 4 days, showing you this narrative. And obviously what the boys are going to do on the Thursday night is that they're going to show you some of the tools we use in terms of the order flow tools that are available on Sierra Charts and on NinjaTrader. They're going to show you some of the tools we use in the sense of an order flow setting to try and recognize the absorption areas where the people can buy into, the idea of withdrawals of liquidity, the idea of some of these kind of key technicals, the idea of the things you can add to your picture, the idea of the things you can add to your basket to make the trade decisions come true. So they're going to show you that on Thursday night. And then on Friday, of course, we'll finish off with an idea of how to deal, going through a candlestick by candlestick analysis of one of the markets. Now, I wanted to show you, a lot of you guys don't trade oil, perhaps, which is a pity because it's been one of the biggest markets we've had in the last few months. It's been enormous. In fact, I was telling the guys earlier that I was bored, okay? So I totaled up the value of the tweets for the last 5 weeks. If you'd taken the tweets and taken the trade we suggested, and it's only a scenario, guys, remember that. You've got to still check the scenario is still valid. And if you traded that trade, just that trade on the tweets, in 5 weeks, you made $100,000. 5 weeks, $100,000 on one contract. Now, that's the maximum swing. You're not going to get the maximum swing. We know that. But so what we always say is that's what you would have made on 3 contracts. And that's on oil in 5 weeks, guys, $100,000. Now, obviously, oil's been incredibly volatile. Today, you've seen 2 trades. You might be saying, that's bollocks. That's impossible. We've just shown you 2 trades. They were tweeted for $5,000 per contract, guys. So you think that $100,000 over 5 weeks would be impossible? The oil has been massively volatile. Not just volatile, guys, massively volatile. So when we understand that massive volatility, when we understand that idea of volatility, one of the key aspects is very, very simple. Take advantage of it. Don't play the quiet markets when we've got this amount of volatility, right? So let's take a look at the S&P and try and spot where we would have been dealing on today's S&P, even from this afternoon or this evening, guys. Take a look at it for yourself. I have 2 R squareds on the line at the moment, 2 R squares on the chart, so that you can get a feeling for what I am seeing as a commercial operator on the S&P today. As a commercial operator on the S&P, what am I seeing? Take a look at the cash market open, guys. If R squared is a positive correlation to the blue line, if R squared is a positive correlation to the blue line, what would you have done at the cash open, guys? Take a look. Make a decision. You'd have been selling, correct? You can see that very definitely you'd have been selling today's S&P highs. So what would you have done to sell it? You'd have looked in the background and you'd have come up with some structure. You'd have drawn perhaps this level here, And you would have came up with some structure to sell the S&P into as a commercial, correct? So obviously the price trades up into this structure area here. We get some level 2 sells, and the price break structure lows here, and you would have been able to take the intern's sell in line with R squared right there. The sell was at 41.33s, and the price dropped down to a low price of 41.20s, and you made 13 points profit, $650 per contract on that sell. Pretty good start to your day. Now, obviously, if you are now approaching it from a structural point of view, we broke structure just here, didn't we? So we broke structure at that price there. High price, structure break here. So obviously, during that structure break, the high price is now what price? Well, guess what this is? This is now what we call a bearish order block, yes? This is now a bearish order block. This is a price that you would now be marking on your charts as a bearish order block. It's in line with R squared. It's in line with the value that we have in the markets. So obviously, based on that structure, we can already start to recognize some incredible level 2 opportunities. Now, remember, we're commercial traders. If you join our main room to learn all of this stuff, you will become a commercial trader as well if you want to. Don't have to become a commercial trader. A lot of people also, whilst I'm at it, whilst I remember, a lot of people say, I don't trade 1 minute charts, I trade hourlies and dailies. Guys, this is not time frame dependent. It doesn't matter if this is a 1 minute chart, a 15-minute chart, or a daily chart. It makes not a jot of difference. The principles are identical to a 1 second scalper. Obviously not quite the same because you're taking 1 tick scalps and that's slightly different, but anyway. So you can start to recognize whether we would sell as a commercial seller. Well, when the price trades up into this level 2 liquidity here, breaking the level 1, the value is actually going up. So I don't really like that as a sell, right? I don't really like it, so what am I going to do? Going up. So I don't really like that as a sell, right? I don't really like it, so what am I going to do? Nothing. I'm going to leave it alone. I'm going to say thanks very much, but no thanks. Not today. And when the price trades level 2 liquidity here, and I'm going to look at it, I'm going to say, no, you know what? No thanks. I'm not seeing what I need to be seeing to get that short trade on the books, right? Now, it's disappointing because it worked out beautifully. So you might be saying, you're an idiot. Why the hell did you not sell that? Because that's a great looking sell. Well, I'm just saying, based on what you guys are seeing on this chart, right? I'm trying to show you what you guys would have been seeing. But take a look at the next retest. Here. Another level 2 liquidity. The price goes above, comes back below and creates level 2 into a bearish order block. But this time, R squared is divergent. In other words, draw a regression line on R squared. Draw a regression line on R squared, and that's what price should be doing. Now, I have commercial value to sell this higher price. Now, I am going to be selling as much as I can as a commercial seller in these top edges here. Now, I'm going to switch on the algorithms. Now, I'm going to be getting the interns to start selling at lower prices because I've got value to sell into these lower prices. So the intern comes in and starts banging in some sells, and then we get a level 2 sell in here. And you might not be able to see it because it's in such small detail, but you get a level 2 sell in here, and then we get another intern sell when we break structure low here. We get another intern sell. We're back in the market here, and so on and so on. And we get another intern sell here, and the value's still dropping, guys. And we get another intern sell here, and the value's still dropping, so we get another intern sell here. And you can see that the interns are getting a massive field today here of selling. Massive field day on the short side here, making massive amounts of money back down into the day low. Now, obviously, one of the key aspects to this is that we then have a day low. We already know that there's a day low in place, so we mark off that level. We can see the market is definitely bearish. We get a press to the upside, and obviously at this stage, we see a structure break on the back on the upside here. Now, obviously, this becomes a commercial level 2 sell. There it is. So there's a commercial level 2 sell right there. When the price retests back down into the lows, you'll see that the value is actually not dropping any further. So in other words, the interns are never going to sell the lows, are they? Because the value is not in it. This is the extra knowledge, the insider's knowledge that every retail trader doesn't know about. No retail trader knows about this stuff. So obviously we're not going to sell into the bottom edge, so that's good news. We don't get selling there, but we do have value to sell as a commercial at the top edge. So there's our next commercial sell trade right there. As we come into the bottom edge, the value is not only dropping, it's not dropping, it's actually rising. So obviously as a seller, I'm going to say, you know what, get me off this trade. This is bollocks, right? This is rubbish. There's no way I'm going to be in this sell trade any longer. Now obviously when the price rises, only one of our R squareds rise. We don't get two lines rising. So we're left with a decision. Do we just now take time off? Is that us finished for the day? Perhaps. Can we sell the top edge? No, the value isn't allowing us to sell the top edge. I don't have any commercial sales in this. But look at what happens next. Do you see where the next trade is? I bet you do. I bet you see where the next trade is, guys. The bottom edge buy. Right there. Look at that commercial buy trade, guys. And I know it's a commercial buy. But by recognizing it as a commercial buy, guess what happens? You're then able to bring in your structure break. So when we break structure there, the interns are now in and about it, guys. So the interns buy it. And then we break structure again here. And the interns buy it. And guess what? We're off and running now with a brilliant one, right? So we sold this whole phase. We sold the cash open. We sold this whole phase. We did feck all during this phase. You might be saying, but why would you not potentially have bought the bottom edge? Well, perhaps you might have here on a level 2. There may well have been a very good excuse to buy into that phase for sure. That's a level 2 commercial buy zone in there. And obviously there was no intern buy trade through that phase because the value just didn't improve for us at the bottom edge, right? And then we became a buyer here at 19:30 London time, 2 hours before the cash close. And obviously from that point onwards, you can see that we didn't really develop any more upside value. You can see one line drops, one line rises. We don't really get any confluence of information here. We're happy just to book some profits. And coming into the cash close, you can see we've got a little bit of short value in here and a little opportunity at the cash close just to either get a little bit of short business or just tidy off our longs and finish off for the day. If you took those trades, if they were your trades, if they were the trades that you were trading today, guys, is what you would learn in this classroom worth $100,000 a month? Absolutely. You've just seen oil trades worth $5,000 per contract in one day. You've been able to recognize this as a chart that doesn't repaint, as a chart that doesn't lag, as a chart that has an unbelievable profit and potential, regardless of whether you trade commercial sells or whether you trade algorithmic sells as HFTs or momentum trades. Massive amounts of potential profit. Is it simple? No. Is it the easy button? No. Is it the way trading actually works? Well, the tweets will tell you that it's the way trading actually works. There's no mention of a bounce off of a 50-day moving average. There's no mention of a Fibonacci, and that's why we got a buy trade on. There's no mention of a stochastic being oversold, is there? There's mention of real-time supply. There's mention of a wholesale commercial seller at $91 a barrel. These are all mentioned before the trade ever takes place. An enormous advantage. An enormous improvement on every other retail trader in this space, guys. Enormous improvement on everybody else in this space. That's why this room is unique amongst all the rooms. We don't tell you to trade a style. We tell you how to trade the markets. Not from fundamentals, not from technicals. We don't have a style of trading. It's just the way it is. It's proper bank dealing. But there's a lot of different ways to bank deal. Commercial bank buys, bottom edges, commercial bank sells, top edges, commercial bank algorithms, buying momentum shifts, prop desk banks, buying algorithmic shifts. You've got to learn all of this stuff. It's not easy, but piece by piece, step by step, you start putting the stuff together as we're doing in these classrooms, and you start learning this stuff. I'm going to finish off at that, guys. And the glorious news, of course, was that we beat the the Belgians 3-0. Woo! Unbelievable. Unbelievable. And because of this class, guys, I wasn't at Ibrox tonight. So I better get out of here, guys, and I'll have a little Jack and Ginger to celebrate. Kim owes me one in this one. Kim owes me one big style. I hope you found something of interest, in all honesty, guys. We're here not to sell you something. We're here to try and get you to understand about what trading really is so that you start asking the correct questions. There's no fancy sales. There's no glossy screenshots. There's no fancy presentations. I'm not polished. I'll tell you how it is. We abuse the people in our room most of the time when they've screwed up, and they screw up a lot. They'll tell you themselves they screw up a lot. They miss trades a lot. But guess what? Now they're honest about it. Now they say, I did screw up. I screwed up. I should have had that trade. And I say, well, why didn't you? And they're able to analyze why they didn't have the trade on. They're able to analyze the deal, why they weren't involved, and we're honest. I miss trades all the time. I never got that buy trade. Did you not get that buy trade? No, I never got that buy trade. Come on, Ray, what the hell's wrong with you, right? And then we've got some in the room that start front running my buy trade. They know what I'm going to do, naming nobody called Nessie. But we've got some people that front run my buy trade. They're doing me out of business, guys. So obviously, if you want to learn the truth about the markets, this is where we're doing it. These classrooms, this idea of who's dealing in the certain locations, how do they deal in these locations, what are they looking for in these locations. So what we're going to do on Wednesday is we're going to just go candle by candle and analyze these ideas. Not from an R-squared statistical arbitrage aspect, not from a fundamental aspect, but we're going to be looking at order flow. We're going to be looking at volume analysis. We're going to be looking at structural analysis. So that's something that when you leave here, if you decide that's it for you, you couldn't care less about what we do in the future. If you want to just leave here with something that you can use, then we're going to try and give you that. Hopefully, we've already given you some ideas to use in some of these incredible trades that we've already seen. Just getting away from being two-sided is a massive step forward. I hope you agree. Being able to eliminate the sell side of the bottom edges, being able to eliminate the buy side of this structure here is enormous, allowing you to sell down into the bottom edges and make the most money possible. Crazy good opportunities, right? So, I'm going to finish off at that, guys. I always promised we'd do these for about an hour. We've done another 2-hour session, so I apologize again for keeping you too long. We'll try and do better tomorrow, but no promises. I'll see you guys tomorrow night at 8 o'clock, and the other guys that come into the room, I'll see you guys in the morning, you bunch of miseries. And we'll get started all over again. In the meantime, I'm going to say adios amigos, arrivederci, auf Wiedersehen, sayonara, tutsin, tax,